Good day everyone, this is your European Open briefing for Wednesday 10th of August 2016. My name is Michael Frentiates, I'm the Chief Economist here at XM.com. These are the key points you should know about today. The dollar has given back almost all its employment report gains from Friday on the view that the Fed is still nowhere near raising interest rates in the United States. Weak productivity numbers were also seen hitting the US dollar. The pound climbed over 130 against the dollar also, and we'll talk about other currencies, what they are doing against the dollar as well. We have some risk on sentiment, Asian stocks hitting one-year highs, some positive moves around, but oil was hit by the American Petroleum Institute crude inventory build. A drawdown was expected, and the Energy Information Agency numbers later today are expected to have some more clarity of what is happening in the oil market. In Canada, we had Japanese machinery orders, job openings and labor turnover survey in the US, the Reserve Bank of New Zealand after the US close expected to cut. Now, onto the dollar index, you can see the big jump after the non-farm payrolls, but we are seeing the decline also coming near the levels, around the levels that it was before the non-farm payrolls announcement. Now, the market is not expecting a Fed rate hike soon, so maybe it's premature to give the dollar too much of a lift. So the dollar sold off also after the weak productivity report. So we see here quarter-on-quarter productivity growth, and you see that for the past 3 quarters this has been negative. It has been improving, but it's still negative. So weak or negative productivity growth means that more workers will not necessarily translate into stronger growth. So we see that a strong labor market may not mean that we get better GDP. Plus, wages are not going to increase as much unless output per worker also goes up. So we measure productivity with output per hour. Something for you to take note. So economists were expecting plus 0.4% for productivity. It actually came a negative 0.5% and close to the 0.6% previous estimate. Now, productivity, I will point out that it's a little tricky to measure, so just keep that in mind, that it's not an exact, I mean, with all economic statistics, it's not exact science, of course, but productivity is a little tricky. Just keep that in mind, that it's something that people can debate a lot about. And anyway, plenty of majors found an opportunity to beat back the dollar's recent advances. For example, sterling very much in the headlines these days. It pushed almost to 1.3090, and this was a good chance for it to break above the 130 level once more, which is proving which could prove like a focal point for cable for now. Dollar again fell below 102 to 101.4 or thereabout, and euro dollar was back above 111. The Aussie was closing around 77 US cents, so the Aussie also very strong. Now, keep in mind that this is a thin market, and it might be easy for pairs to be pushed around by relatively fewer orders compared to normal trading conditions, that is. So this can account for choppy trading. The dollar was up, then it was down. This reminds me a bit of is the dollar the Grand Old Duke of York? This is a well-known nursery rhyme. Grand Old Duke of York had 10,000 men. He marched them up to the top of the hill and marched them down again. And when they were up, they were up. When they were down, they were down. And when they were only halfway up, they were neither up nor down. So reminds me a bit of the US dollar going up and down that hill. On to stocks, we see the S&P 500 futures close to their all-time highs. Not a lot of correction there. So the prospect of Fed in action and decent economic performance at the same time is keeping stocks near their all-time highs. Also, earnings in the US were not as bad as feared. That was a contraction, but not as much as feared. And stocks in Asia also made a one-year high today. Oil also a big focus in the market these days. The talk of an OPEC output freeze seems to be putting some floor on oil, but at the same time we do have some bearish data, inventory data, indicating that the market is still oversupplied. For example, we had the American petroleum inventories yesterday. They were bearish. Inventories, instead of going down 1 million, they went up 2.1 million. So today's crude and gasoline inventories are expected a 1 million draw. Oil traders will be watching that closely, and of course keep in mind that you should not only watch the crude oil inventory build or draw, but also gasoline and the products, because last week we had a big build in crude, but a big draw in gasoline, so this was countered and we saw some sharp reversal of the first reaction. On to the data, we had machinery orders in Japan. A very positive picture, and it's very interesting that the strong yen is not hurting the Japanese economy as much as feared. Maybe the fiscal stimulus is supporting things there. Maybe the Japanese companies are learning to deal with this. But yeah, machinery orders much better than expected, limiting that year-on-year drop that was expected. Australia consumer sentiment also came in stronger, but housing finance was a little bit weak. The Reserve Bank of Australia Governor Glenn Stevens said that monetary policy had limits in its abilities, and it was time for fiscal for the government and to push up growth. And that was the final speech by the outgoing RBA governor. We also had French industrial production for June, which was a disappointment at minus 0.8%, expecting a 0.1% increase. And we have later in the US session job openings, which are expected around 5.5 million, a bit more than 5.5. Finally, Energy Information Agency stocks are expected to be down 1 million each for crude and gasoline. And lastly, RBNZ is expected to cut from 2.25% to 2% after the close of US trading today. So, but the Kiwi is looking very strong today, as it has topped 72 cents versus the US dollar. So the Kiwi jumped almost by a cent versus the dollar. So that's all from me today. Thank you very much for watching and have a great day.